Hello and welcome to Speculating with Foreign Currencies. My name is Norbert Racone. I'm the author of the books Futures for Small Speculators, as well as the new book Forex for Small Speculators. I'm also the president of Liverpool Derivatives Group, and our motto at Liverpool Derivatives Group is to bring security to speculative investing. And I hope I've done this in the past tapes regarding futures and traditional commodities, as well as bring that same feeling to the foreign exchange tape that you'll be watching today. Now, before we begin, I believe it's important to let you know that I am a Series 3 licensed futures professional and a member of the National Futures Association. So I bring a different perspective to many of the tapes you've seen today, and as well as in the past. My focus is typically on giving you a behind-the-scenes look at how foreign exchange developed, why it developed that way, and why it's today's most exciting investment as opposed to many others. Foreign exchange is a relatively new investment. It's been around 30 years, and it's highly speculative, more so than stocks, futures, or traditional commodities combined. So it's good to have a basis or foundation for understanding this. Let's begin. Now, with getting started, before we get started with this particular video, I'd like to focus on the risk disclosure. And the risk disclosure is very important because foreign exchange, futures, or commodities trading are all very risky, and they're not for everyone. So if you can't afford to lose part or all of your investment, then this is not the investment for you. As well as any information provided in here doesn't represent or warrant that you'll be able to succeed or make a lot of money, nor does past performance indicative of future results. Take this risk disclosure to heart before you decide to make any investments, and definitely consult your broker, your CPA, your attorney, whomever, before making any of these kind of investments. Now, this particular focus is the getting started with foreign currencies. It's also known as foreign exchange, as well as foreign bonds or any of those permutations. It's basically being able to trade currencies in a marketplace. Now, in the last tape, getting started with futures and traditional commodities, we had a very extensive technical analysis section. The technical analysis that we discussed in that tape readily applies to foreign exchange and as well as the OTC market and futures foreign exchange. So a lot of the ideas and concepts regarding Bollinger Bands, Williams percent R, accumulation distribution, as well as the concepts of commitment of traders report are all equally applicable to the foreign exchange market. Both of them are both leverage investments. So in this particular video, we're going to focus on 4 core concepts to kind of catch you up to speed on why you should be trading foreign exchange, why it's become popular, and what to look forward to when you decide to trade in foreign exchange. First, we'll cover the history of foreign currencies. Unlike stocks or futures, which have been around since the 1800s, foreign exchange trading is relatively very new. It's only been around approximately 30 years as we know it, and yet it's 4 times as large than the stock, commodities, and bonds combined. So it's a huge marketplace to only have been around such a short time frame. So understanding how it came to be can give you an idea of where foreign exchange is going, especially since it's in this nascent development. We'll next look at fundamentals of foreign exchange. The fundamentals of foreign exchange are varied. There's 2 types of foreign exchange that are discussed always. There's the OTC market, which is the over-the-counter cash market, as well as the futures type of foreign exchange trading. And all of these interplay and interwork together, and we'll talk about that, as well as just basic elements that separate the 2 and give you an idea of what may be better for you. Next, we'll talk about the influences and the various reports that come along with foreign currency exchange. More so than any other investment, foreign currencies are affected by everything that happens in a country. And so when you look to invest in foreign exchange, it's good to know where the information is coming from with job reports, interest rates, import-export data, as well as gross domestic product. These are all very important factors in deciding what markets you want to trade, and we'll discuss that and where to find those reports. And then lastly, we'll talk about tips to trade foreign currencies. Foreign currencies are very unique in that they trade 24 hours a day, 6 days a week. It goes from London to Tokyo to the United States and then back again. There is no lull in trading foreign currencies. And this is a good thing as well as a bad thing. And for those that are unprepared, it's easy to wear yourself down attempting to trade the entire market. And so we'll give you ideas and tips on how to trade the market effectively for your lifestyle and your schedule so that you just basically don't go insane. It's a wild market, it's very exciting, it's very fast, and at the same time, it can be very stressful. Let's begin. First, we'll touch upon the history of foreign currencies. Now, the beginning of foreign currencies began in the 1950s with the currency policy that evolved out of World War II. There are three core factors which we'll see are a consistent theme in the development of currency trading since the 1950s to present day. And those three themes are, number one, war. Whether they're declared wars or undeclared wars, war has a huge impact on how currencies are perceived. And the first time this occurred was at the end of World War II. The second thing is we'll talk about in the 1950s, gold and how the gold standard affected the currency market. And then the third thing we'll talk about will be how currencies evolve from there, with the dollar being in various foreign banks. Now, the next thing we'll talk about will be the floating currency catalyst, how all this changed and evolved from the 1950s era into the 1970s, and really set the stage for how we trade foreign currencies today. And then the last thing we'll talk about, the modern currency foundation, and really kind of gauge and look forward to what's going to happen next. Now let's get more in depth into the 1950s era. And as I said, the three core factors that shaped the 1950s currency policy were war, the gold standard, and the dollars in foreign banks. And let's dissect each one of these to get a clearer picture of how the world was set for foreign currency trading. Now, at the end of World War II, Western and Eastern Europe found themselves in a unique and unfortunate position. Their economies were devastated, their countries were devastated, and America, who had come in at the last minute to save them, was in a huge economic point of stability. Our production engine had been created to put us into the war, so we're more than capable of being a manufacturing center for basically the rest of the world. And many of the Western European and Eastern European countries felt that if the U.S. were allowed, the strength of our economy and the strength of our currency would give us the capability to basically go around buying up whomever we choose and basically grow a lot larger than we were. And so what occurred as a good faith with our allies and some of the Axis powers at the time was the creation of the Bretton Woods Agreement. And what it did was simply peg every currency in the world to the U.S. at a fixed rate. Now, this gave foreign countries the capability to build up in peace without having to worry about the U.S. Overstepping its boundaries and acquiring more than they thought it deserved. But it also gave the U.S. the ability to have fixed rates of export and these other countries to have fixed rates of exports and imports. So it was a great idea. We see this today with the Chinese government. The Chinese government has pegged the Chinese yuan directly to the dollar at 8.4 yuans to the dollar. And in the last decade, we've seen the growth of the Chinese economy by leaps and bounds. And so you have to think back that this is the exact same concept that the founders of this agreement had in mind in helping to rebuild Western Europe. Now, when they pegged the U.S. dollar to these foreign currencies, they set a standard. And that standard was that no currency would be capable of moving 1% higher or 1% lower than the peg. So there was no true currency fluctuation at that time.